All right, we're building portfolios. Everyone's got their way of doing it, but I'm going to talk about a strategy that I think is one of my favorite ways of building wealth for the long term. Today we're talking about the dividend snowball, something I'm using in my own portfolio to build wealth through passive income. Dividends are something that I think are underutilized by people in the finance community. They're slow, they're not super exciting, but I think they are reliable, and the way that you can bet on their income for the future is a great way to get this going. When you get started investing, it's pretty slow at first. You start with $1,000, you hope to make 10% a year, that's $100. Not super exciting. But the whole idea is that by the time you get years down the line, you are building wealth and you are replacing almost a full year's of salary by doing nothing. And that's the whole point about investing. So the way that we're going to do this is using the dividend snowball, a strategy that I think that more people should take a look at. Today we're going to talk about 5 important things that you'll need to know before using the dividend snowball. The first is, what is it? It's a concept that maybe some people have heard about, maybe some people have not. We're going to explain what it is in the video. Number 2, we're going to talk about picking the right stocks. A strategy is only good once you've picked out the stocks. If you have a strategy set in place and the stocks you pick aren't great, it's not going to do well for you and you're going to get pushed away from it even if the stock strategy was going to work pretty well. So we're going to pick the right stocks. Number 3, we're going to talk about DRIP. This is the dividend reinvestment that is critical for this strategy to work. Number 4, we're going to talk about how to accelerate the snowball. I talked about how it's pretty slow to start, and we're going to talk about a couple ways that you can get this snowball rolling downhill way quicker. And then we'll finish up the video talking about taxes. Taxes are not fun to talk about, but the way you can minimize them is a great way to build wealth. You can make more money, or you can try to spend less money, and taxes are a way that we are giving money back that we've made in the market. So we're going to try to avoid that at all costs. So number 1, the dividend snowball, what is it? The dividend snowball is a strategy that uses dividend stocks to accelerate growth of your portfolio over time. You're using these dividends and they're going to be reinvested back into your overall portfolio. This doesn't work if you have your dividend stocks and then you take out the dividends. Dividends are great because you can do whatever you want with them, but this strategy is 100% based off of reinvesting them back into the market and especially back into dividend stocks. It's the idea that once you start investing, you're getting dividends on a regular basis. They can be monthly, quarterly, annually, but you know when they're going to come. This money is reinvested back into the stocks, and in addition to your contributions that you're making on a regular basis, this accelerates your wealth building potential a lot faster than just having your money sit in the overall market, and it gives you much more flexibility. I mentioned you can do whatever you want with these dividends. At first, we're going to want to reinvest them to try to get this going as fast as possible, but some years down the line, you're going to be making significant money, tens of thousands of dollars annually based off of dividends, and you can do this to retire early, you can use this to pay off a house, you can do whatever you want with it, but you need to get it started early. The most exciting thing about dividends to me is the idea of sitting on a beach somewhere and having these reoccurring dividends being deposited into my account, and I can do whatever I want with them, and that's why I think the dividend snowball strategy is so exciting. So part 2, let's talk about the stocks that do the best in the dividend snowball strategy. As I mentioned, a strategy is only as good as the stocks that you put into it. You can have the perfect day trading strategy, long-term swing trading strategy, but if you pick bad stocks, you're not going to do well. So let's talk about some of the criteria that I use to pick good stocks. This is not financial advice. This is just the criteria that I use for picking my own stocks for my dividend snowball, and they're kind of the ones that have worked for me over the past couple of months and I guess this full year. An attractive part about the dividend snowball is that not every stock pays a dividend. You may hear this and go, why would you want to do that? It limits the amount of stocks that you can pick in your portfolio. If you look at the total number of stocks that you can buy in your portfolio, it's pretty large. You have so many options, but since not all stocks pay a dividend, it limits the amount of stocks that you can pick and allows you to really narrow in on the best stocks for your portfolio. So based off of that, I'm looking for 3 things. The first thing is the dividend yield that is higher than 2%. 2% dividend yield is not super high. You can find dividend yields up to 12% if you really want to, but I think this is the sweet spot between 2 and 3.5%. This is a yield that I think is sustainable over the long term, and it's going to be able to give you enough money going back into your account that it's going to allow the snowball to accelerate rapidly. You can get some stuff like Apple that pays a really low dividend. That's really not going to accelerate the snowball over time. The stock may do really well, but we're trying to use the dividend payments to accelerate the snowball instead of picking stocks that are going to, go up in value or go down in value significantly. That's another great thing about dividend stocks is that on average they have a lower average move than the overall market, especially the tech stocks that mainly people are investing in these days. So number 1, we want a dividend yield of over 2%. A higher yield is sometimes a red flag. If you see a yield that's like 8%, you may need to look to see if that's sustainable. Some of the ways that we look at that is the payout ratio. This is a ratio that shows the amount of earnings that are paid out. Dividends are a reward to investors based off of the amount of money that the company's bringing in, and this payout ratio is a ratio of the dividend payment over the amount of earnings that they're bringing in. If that number gets too high, it's not going to be sustainable because the company needs to keep some of that earnings for themselves to grow and pay their debts that they have. That's why we don't want that high of a dividend payment, and that's why 2% to like 3.5%, maybe 4% is the sweet spot that I'm looking for. The next thing we're going to look for is a company that has been consistent with adding on to their dividend. The way that I look at this, there are categories called dividend aristocrats, which means that they've increased their dividend payment every year for the past 25 years, and dividend kings, which are the top dogs. These are companies that have increased their dividend payment annually for the past 50 years. That is such a long time and so exciting. This shows that the company has weathered recessions, different political parties, everything that could go wrong in a market has gone wrong in the past 25 to 50 years, and it's shown that they are able to have a healthy dividend and pay it out on a regular basis and increase it. It doesn't mean that the yield's going up, it just means that the dividend payment's going up. So as the stock price goes up, they're increasing it as well. It doesn't mean the yield is going to keep up with it, but it just shows that the dividend payment is going to increase over time, and so that's why we're looking for criteria 2, that they've increased it for the past 25, at least 25 years, sometimes up to 50 years. And then number 3, we want to make sure that the stock price is going to increase as well. There are some dividend traps out there, meaning that there are companies that have really attractive dividends when you look at the percentage, but then when you look at how the company's done over time, it has underperformed the overall market. So we're looking for a stock that has outperformed the overall market while also paying a dividend. An example of that is AT&T, which is the classic example of a dividend trap. This was a stock that was paying between a 7 and 8% dividend, which is super attractive, especially with a name like AT&T that everyone knows. Then you look to see how it's performed compared to the S&P 500 over the past whatever time frame you want to look at, and it has significantly underperformed it. So we're looking for stocks that have outperformed the market and also have a dividend. So this really narrows down the range that you can be looking for, and I think that's a great thing to do. The less options you have, I think sometimes the better. In summary, the things I look for: a dividend yield over 2.5%, going up to around 4, maybe 4.5%, not too much more than that. We're looking for a company that has increased their dividend payment for at least 25 years, and a company that has outperformed the overall market in addition to the dividend payments. Let's talk about the most critical part about the dividend snowball. You can get all the rest of it right, but if you don't do this, you're really going to miss out on the long-term potential, and that is the DRIP, or Dividend Reinvestment Plan. This is the idea of automatically reinvesting the dividends back into the stocks that you've already owned. This can be done automatically now. Back in the old days, you would get a check in the mail and you had to physically go deposit it and put it back into the market. Now you can have it set up with your broker to automatically do it, and it'll buy fractional shares, which I think is so much nicer. So you can enroll in this program. I'd just say Google search whatever platform you're using. I'm using TD Ameritrade and Charles Schwab. You just look up that dividend reinvestment and you don't even have to think about it. But this allows you to increase your portfolio size without increasing the amount of money that you're adding to it. And so you might not think this is going to do a lot, but over time, I'm going to be getting around $150 worth of dividends for my house fund, and that's just more money than I'm going to be able to add on to my portfolio. It may not seem like a lot right now, but $150 is $150 that I was not having the ability to add into my portfolio that I will have now. So this is the crucial part. DRIP, you can do the dividend snowball without it, but it is really not going to get going if you don't have this set up. So that's number 3. Number 4, the thing you're probably asking is, how can we accelerate this plan? You're talking about getting $150 a year in dividends. That's not super exciting. Obviously, some of the ways that you can do it is you can add more money to it, or you can increase the amount of time that it's going to take. Time on your side is the best thing that you can have as a young investor, and that's why I think it's super exciting to start investing early. But what are some things that you can do to make sure that the dividend snowball gets going? And one of the things that's really exciting to me at a time like this is buying the dip on these really well-known stocks. Dividend yield has to do with a function of the stock price. So we talk about a stock price going up, and as the dividend payment goes up, it doesn't necessarily mean that the yield is going up, but in general, if the stock price goes down, the yield is going to increase, and that makes it more attractive because you're getting a higher percentage of dividend payments based off of the money that you had. So when you look at the overall market, stuff is down right now, and this gives you the ability to buy stocks at a lower price, but it also means that the yield is going to be higher than it was 6 months or a year ago. So if you have a stock that was trading for $100 and pays a $2 annual dividend, that's a 2% dividend yield, and that is kind of the criteria that we were looking for. But what happens if that stock price goes down to 75 bucks? It is now cheaper than it was in the past, so it makes it more attractive if you know that it's beat the stock market on average for the past 25 plus years. It makes it more attractive, and it pushes up that dividend yield to 2.67%. So you're getting a higher dividend yield, and you're getting the stock that you already like at a discount. So For a time like this, when we're looking at the market, I'm looking for stocks that are down significantly from their pandemic highs as an opportunity to not only get the rebound of the stock price, but also a higher dividend yield if things go flat or down for the upcoming future. This is very critical to make sure that you're buying stocks that have the track record of being able to increase that dividend payment, because you don't want a stock that was $100 going down to $25. You're looking at it and that's an 8% yield. That's so exciting on a stock that you already love. That might be too much. So there is an extreme end for pretty much everything in a investing strategy. If a stock price goes down too much, that might be a red flag that the dividend yield is not sustainable. So you got to look to see what is it a reasonable drop. For dividend stocks on average are going to be dropping less than the overall market. So if you see a stock that goes from 100 down to 25, that might mean that you need to take a deep dive into what's actually going on there. And number 5, we're going to talk about taxes. And before you click away, taxes are something that you really need to understand when talking about dividends, because it is more complicated than just buying and holding a stock forever, because you're going to have to do it on your taxes every year if it's in a normal brokerage account. So what are some ways that you can minimize your tax burden when it comes to tax season? We're coming towards the end of 2022, and that means that taxes for this year are wrapping up. So you need to make sure that you have an idea of what's going on, and if you're going to have a tax bill, you need to have money set aside to be able to pay that. Dividends are taxed in different ways depending on where it's coming from and what type of stock it is. So qualified dividends are taxed at the capital gains tax rate, which is much lower than the normal tax rate. If you make under a certain amount of income, that could be 0%. This is going to show up. If you want to see what type of dividend a stock pays, you can either Google it, or if you've already been getting that dividend payment, you can go to your history and see what pops up for it. I'll put up right now what my TD Ameritrade portfolio looks like with the dividends that are coming in. So qualified dividends are taxed at capital gains rate. That's what we want to see. And then you have non-qualified dividends or ordinary dividends that are taxed as ordinary income, which is going to be that normal tax bracket that you've always seen. This is not as attractive, but you just need to know what's going on there. And one way to avoid this is by keeping dividend stocks in a retirement account. If you put it in a retirement account, especially a Roth account, where all the money is going in post-tax, all of the gains that you're getting off of that is tax-free. It makes it more simple for tax season because you're not going to have to pay the taxes on that and fill out the paperwork for it. And it means that all of that growth is going to be tax-free by the time you take it out. You do need to kind of consider when you're going to want this money. Is this something you're going to want at 40 years old? If so, maybe a normal investing account is going to be the way to go, because if you take out money out of a retirement account beforehand, you may have to pay some taxes up to 25% depending on how much money you're taking out. So always make sure that you have a plan for the future, because if this portfolio starts really taking off and that snowball is going down the hill fast, you might get to the point where it's sitting in a retirement account and you kind of want to hit that money, but you can't get it without the tax penalty that we talked about. So make sure you know what your plan is for the long term, just so that you can minimize your tax bill overall. That's something we want to do. We're making money in the stock market and we're trying not to pay it back to the IRS as much as possible. So overall, that is the dividend snowball. This is a strategy that I've been using for the past year and a half, and I've been using it pretty aggressively in my retirement accounts as well. This is something that I think you're allowed to pick stocks from a much smaller range. You have so many options on the overall market. You can just see how many videos there are talking about various stocks and options. And when you're looking at dividend stocks, it really narrows it down, especially the criteria that we looked at. So let's summarize the video overall. Part 1, we were talking about what the dividend snowball is. It's the idea of having a portfolio based around dividend stocks and then reinvesting those dividends in addition to adding money to it consistently. And over time, the dividend payments are going to increase to the point where you're able to replace a significant portion of your income without having to do very much. Part 2, we talked about picking the right stocks. The criteria that I look for is a dividend yield over 2%, but under 4.5%. It has to be have increased their dividend payout every year for at least 25 years, preferably longer than that. And then finally, it's had to outperform the overall market in the past 25 years, just because during that time frame, you've had every different type of market conditions that we've seen. We've seen recessions, we've seen geopolitical problems, we've seen different political parties in charge, and it shows that it can weather the storm, and you don't want a stock to go bankrupt if it's a crucial part of your overall portfolio. So those are the criteria that I look for. Number 3, the most critical part of the dividend snowball is a dividend reinvestment plan. This can be done automatically and buy fractional shares of the stocks that you already own. And this is a critical part because this is what really gets the dividend snowball going down the hill faster. And then number 4, we talked about accelerating the snowball. We can buy stocks at the dip. You're getting stocks that are going to be at a cheaper price, so you're going to have the capital appreciation of the stock in addition to the additional yield. Yield is a function of the stock price based over the overall payment, and assuming that the payment doesn't decrease, that means the yield is going to go up, and that makes it more exciting investment opportunity, especially in a time like this where stocks are down significantly from their pre-pandemic highs. And then 5, we talked about taxes. Make sure you know what your tax burden is going to be at the end of the year. If it's in a retirement account, you don't have to worry about that. but you do have to make sure that you know that you're not going to be able to take it out without significant penalties, depending on how much money you want to take out. So knowing what your long-term plan is with these dividend stocks is really critical. You don't want to put it in a type of portfolio that you're going to regret in 10 years, so make sure you kind of think it out before you decide where to put these stocks. My name is Andy, this is the Dividend Snowball. Let me know if you've used a strategy like this or if you're considering using it for the future, and let me know what stocks you use for the Dividend Snowball that are attractive. Stuff I love are AbbVie, which is ticker symbol ABBV. We have PepsiCo, we have Home Depot, Procter & Gamble. These are all classic dividend stocks that have a history of increasing their dividend, and they are a great part of my portfolio. Thanks for watching. If you're curious to see what else I do on this channel, be sure to hit that subscribe button. And if you want to see more from me, there'll be a video on screen right now of some other videos I've made in the past about investing in the stock market. So thanks for watching. My name is Andy, and I'll see you in the next video.